Securities and investments. Hi, this is Abhinav Akkiraju from Akkiraju Investment and Trading Group. Today, I'll be discussing my stock market game portfolio. The aim of this presentation is to describe the process of how I manage my stock market portfolio. On an initial investment of $100,000, the Akkiraju Investment and Trading Group portfolio earned $31,748.76 in profit over the course of 3 months, resulting in a total return of 131.75%. The AITG fund also held a 22.21% return over the S&P 500, which had a 9.63% return during the same time frame. Of my initial $100,000, I placed about 11.5% of my overall equity into funds, which I kept for the entire 3-month period. One bond received 16.01% of my initial total equity and was retained for the entire 3-month period. A total of 53.49% of AITG's initial capital was invested in a number of larger stocks, leaving just around 20% of my portfolio available for purchases. For the first 2 months of the investment duration, my fund invested in larger and more reliable stocks. In the last month of my investment period, I decided to take riskier plays and trade with stocks in lower and more volatile price ranges. My investment decisions are focused on in-depth fundamental analysis, research into major events, earning reports, job reports, and personal knowledge of companies. My stock investments, with the exception of Veru and Plug Power, remained in the $2,000 to $7,000 range. This helped us to avoid putting too much money into a single security, which could result in a big loss. The two funds in which AITG invested made an overall profit of 11.53%. These are excellent results for my investment, as I invested in these funds with the expectation of a 5% average profit at the end of the 3-month period. The bond in which AITG invested yielded a negative 2.63% return. This is a bit of a disappointment because I had hoped to make a 1% profit on this bond. The following tables display AITG's most profitable securities and biggest losses. As seen above, the stock Veru had the greatest return, a profit of nearly 99% of my initial investment. Veru is a pharmaceutical company that specializes in cancer treatment. Its stock jumped 207% in mid-December after the company announced an extension of its oncology drug pipeline. Due to the bull market, many stocks were being hyped up to boost the stock price. Owing to that extraordinary occurrence, a few of my portfolio's smaller investments profited. The tables show that AITG has a large number of stocks in the automotive market. Many of those stocks rose as a result of the belief that electric vehicles are the way of the future, making my picks profitable. Overall, the AITG portfolio's performance and limited loss stemmed from not just a thorough environmental analysis of sectors, but also a thorough research process that centered on recognizing a company's efficiency rather than just its market value. It goes without saying that when a company appears to be cheap on a purely quantitative basis, it is often because they are. As a result, I based my investment strategies on taking long positions in good companies with clear competitive advantages. Many of my stock picks are based on fundamental research of companies. The main advantage of this strategy is that it allowed us to see company results beyond ticker symbols in stocks, and it provided us with the knowledge to act based on historical data and expectations. Short-term quality investing nowadays necessitates an unprecedented level of innovation. The days of seeing quality businesses trading at a fraction of their net asset value are long gone for astute investors. Value investment, on the other hand, comes with a lot of risk and little to no upside in the long run, particularly when businesses don't have a sustainable competitive advantage. Although AITG invested a portion of its funds in a few particularly appealing value investments, such as Veru, my investment policy was based on finding good businesses selling at fair prices due to the investment period's short duration. As a result, the bulk of my analysis and security selection was focused on the company's or fund's fundamental efficiency, rather than just its valuation. This also helped us to evaluate ongoing success based on product or service and determine the best time to sell. One way AITG implemented this tactic was to use YouTube to see ordinary people's reviews or thoughts of a product, concept, or event in the comment section. Observing companies' live streams on the internet to learn more about their future plans also aided in determining whether or not it was a secure security to invest in. After finding out whether the company's products are needed, I would begin a detailed historical analysis. This was done by looking at things such as earning reports. This was done by looking at things such as earning reports. After doing this, conducting technical analysis to analyze market health was my next step. I made it a point to look at the moving average convergence divergence for almost all of my stocks to see whether there was a new pattern and if it was bullish or bearish. After viewing all of the technical analyzers and indicators that I wanted to pay attention to, I then finally invested in the stock. Don't put all your eggs in one basket, as the old adage goes, applies to more than just farming. These wise words also best encapsulate the concept of not putting all of your capital into one investment. Diversifying your portfolio is one way to reduce the chance of losing money while investing. This entails making a variety of investments in order to lower the overall risk profile. My cost-splitting approach for diversification was to divide costs by investment type as well as business sector. This means I'd restrict the amount of money I could put into a single sector at a time. I made sure to put 11.5% of my initial total equity into funds and 16.01% of my initial total equity into a bond, in addition to dividing my capital by business. The bonds and funds in which I invested are very consistent, making them very secure long-term investments. I set aside 20% of the remaining 73.49% of my portfolio for purchasing power. Finally, the sector diversification started with the remaining 53.49% of the equity in the portfolio. All of the stocks in the portfolio are limited to 10% of the total equity, aside from 2 stocks that were invested near the end of the 3-month duration. I made sure never to have more than 20% in one sector at any one time. Following a few main concepts when selecting stocks and funds to invest in was critical when selecting stocks from each sector. When it comes to mutual funds, funds with a track record of consistent and modest growth provide stability in a competitive market. To mitigate risk while maintaining steady growth, a focused dynamic growth fund and a large cap equity fund were chosen. Only one bond was purchased due to the short investment period, but it represented 16.01% of my initial total equity and was kept for the entire 3-month period. I chose a treasury bond as a low-risk asset with steady growth that has the potential to provide a solid return with the speculation of rising interest rates. Throughout the investment period, I was tempted to buy into any and every single electric vehicle stock I could find, as I believe that electric vehicles are the automotive industry's future. While I was close to investing in a large number of EV stocks at the same time, I realized that this would contradict my policy of being wary of any random market sector volatility. This decision worked brilliantly for me because the electric vehicle market suffered a correction in late November and early December. Overall, diversification played a significant role in my portfolio and is one of the main reasons why I never witnessed a portfolio correction. The investment strategy I used for the duration of the game paid off handsomely, with a 131.75% return in just 3 months of trading. I overcame obstacles along the way, as any successful investor does, by effectively allocating assets between cash and various securities by diversification. Investing the majority of assets in stocks rather than mutual funds or bonds proved to be a risky strategy that helped enormously over the course of 3 months. The companies that proved to be the most successful, as predicted by my plan, were ones that I had first-hand experience with or that had a very compelling history. These companies were the bedrock of my portfolio, providing a framework for the rest of the returns. Diversifying my portfolio through various economic sectors helped my portfolio avoid a big crash at any given time. Although my portfolio performed well over the course of the 3 months, there were a few places where I could have improved my investment strategy. Aside from a few short-term trades, my portfolio mostly consisted of mid to long-term stocks. My willingness to put money into stocks was already nearing 50% of my total portfolio. Since I only had a 3-month trading period, the long-term stocks I had in my portfolio were taking up a significant portion of my portfolio. Furthermore, shares were only limited to 20% of my total equity when there was little time left in the trading cycle, while it was usually only 10%. While this necessitates riskier bets, it was also during this period that I made the most money. In my portfolio, there were a number of stocks in which I had no direct experience with the company's product. While some of these stocks, such as Veru, saw gains, the majority of them ended up lower than when I invested in them when I invested in them. Having firsthand experience with the company and its goods aids investors like myself in determining if other people would find the company as appealing as I do. One improvement I would make is to use a broader range of technical analysis and charts when analyzing a stock, as the metrics I used often did not add value to the study. When it came to investing, I believe I could have used a little more patience, particularly in the second half of the trading period. Since I made so many trades that didn't benefit or go down in the first half of the trading period, I felt compelled to double down after that. This caused me to make trades too quickly when I thought the stock wouldn't move, despite the fact that it had only been a few days. Waiting to enter or exit a stock is certainly something I should improve on, as I was constantly jumping into stocks directly after doing my research. My trading experience would have been significantly enhanced if I had the patience to enter at the right time and take profits. Overall, I was satisfied with the performance of my portfolio during the trading period. Regardless of the shortcomings I found in my portfolio, I believe I did a good job and implemented a good plan with a high level of effectiveness. Thank you for listening.